Professor William Liebenberg explains that the world is heading toward a major financial shift as January 2026 approaches, with the One Big Beautiful Bill Act activating at the same moment that 90% of global cross-border payments transition onto the ISO 2022 system. And this alignment sets the stage for one of the most significant opportunities in XRP's entire history. As global systems move into early 2026, the One Big Beautiful Bill Act introduces sweeping changes such as a 1% excise tax on outbound remittances and new international tax adjustments, reshaping incentives for how digital assets are used in real-world transactions and creating a more favorable environment for compliant blockchain settlement. With SWIFT's full cutover in November 2025, the world enters January 2026 with more than 90% of all cross-border messages running on ISO, eliminating the old MT coexistence era and opening the door for digital assets like XRP that already operate natively within structured, data-rich messaging standards. Prof highlights that XRP's architecture, fast, neutral, liquid, and fully aligned with modern settlement standards, benefits directly from this transition because ISO enables clean, structured data, transparent remittance details, and automated compliance that traditional banking rails could never deliver efficiently. Yet everything hinges on the timeline of the Digital Asset Market Clarity Act of 2025, which passed the House in July but remains stalled in the Senate, leaving two possible paths. One where the act is signed before January 2026, bringing immediate regulatory harmony, and another where the law only materializes later in the year, delaying clarity but not stopping adoption. ISO itself represents a complete rewiring of how global financial messages are structured, replacing rigid legacy formats with flexible XML-based data models that support purpose codes, detailed metadata, and compliance information that drastically reduce errors, fraud, and settlement friction across borders. The November 22nd SWIFT migration pushes global adoption past 90% by early 2026, enabling faster settlement windows, often seconds instead of days, while strengthening analytics and AML monitoring for the $150 trillion global cross-border payments market. Major institutions such as JP Morgan and Bank of America have already implemented ISO, reporting efficiency gains of 20 to 30%, and by 2027 full compliance will apply to cancellations and reversals, giving early adopters a competitive advantage in real-time settlement. Prof notes that this standardization also levels the playing field for blockchain-based settlement assets because richer data and instant messaging structures finally allow digital assets like XRP to plug directly into institutional flows without fragmentation or manual reconciliation. The One Big Beautiful Bill Act, signed by President Donald J. Trump, extends the 2017 tax reforms while introducing powerful fiscal updates such as a 10.5% beat rate, stronger foreign tax credits, and new exemptions that reduce burdens for multinational firms operating across many jurisdictions. Section 7604 of the Act introduces a 1% excise tax on outbound remittances starting January 2026, exempting U.S.-issued cards but applying to cash, money orders, and certain transfers, and this mechanism is intended to fund border security while subtly influencing how people choose to move money internationally. Activation of the Act in 2026 triggers these new fiscal rules while also expanding qualified small business stock exemptions, creating an attractive environment for blockchain startups building solutions aligned with modern settlement infrastructure. For the digital asset sector, the Act's international tax revisions could lower effective rates on cross-border crypto flows by 15 to 20%, and when combined with ISO automation and data-enhanced compliance architecture, the result could draw $10 to $15 billion in new settlement volume toward efficient digital rails like those powered by XRP. Prof explains that the 1% remittance tax inside the One Big Beautiful Bill Act acts as a gentle push away from slow and expensive transfer methods and toward cheaper digital alternatives, which indirectly strengthens the case for assets like XRP that can move value instantly with minimal cost. XRP, launched in 2012, remains one of the only digital assets purpose-built for liquidity and cross-border settlement, powering Ripple's on-demand liquidity system to move money in 3 to 5 seconds at fractions of a cent, an advantage aimed squarely at the $27 trillion global payments market. While XRP itself is not a messaging standard, RippleNet operates fully within ISO, embedding structured data directly into payment instructions for compliance, AML screening, and sanctions monitoring, allowing XRP to act as a bridge currency without relying on slow Nostro and Vostro accounts. Prof shows that with ISO now live across more than 90% of the international system, XRP can reduce rejection rates from around 6% to under 1%, thanks to richer data payloads that enable automated verification and frictionless payment routing. The One Big Beautiful Bill Act amplifies these advantages by incentivizing firms to shift toward low-tax digital rails, increasing the appeal of XRP as both a cost-saving and compliance-friendly asset, especially at a moment when its market cap sits near $30 billion and clarity remains unresolved. If the Digital Asset Market Clarity Act is signed before January 2026, Prof says XRP enters a phase of unprecedented stability and growth because the act classifies it as a digital commodity under CFTC oversight, exempting decentralized networks from SEC securities restrictions. This reclassification enables spot market trading without investment contract limitations and gives banks the legal foundation to custody XRP without adding it to their balance sheets, unlocking institutional corridors that were previously frozen by regulatory uncertainty. Under this early clarity scenario, ISO 20022's 90% adoption, combined with the remittance tax, drives banks toward XRP for settlement efficiency, potentially tripling quarterly ODL volumes to $50 billion, with ETF approvals further accelerating institutional inflows. Prof notes that price impact in this regulatory green light environment could be immediate, with a 200 to 300% move toward $5 to $7 as liquidity deepens and large ISO-compliant institutions like Santander expand their partnerships. Compliance improvements under the CFTC framework further reduce fraud by around 40% through combined blockchain transparency and ISO data fields, attracting $20 billion of new liquidity pools and positioning XRP as a credible alternative to central bank digital currency corridors. However, if the Clarity Act remains unsigned into early 2026, XRP stays trapped in regulatory fog as SEC and CFTC turf battles continue, leaving banks hesitant and preventing XRP from capturing the full benefits of ABBA and ISO adoption. In this delayed clarity scenario, only 20 to 30% of institutions experiment with XRP, far below the 60% seen in the clarity scenario, reflecting reluctance to onboard a bridge asset without clear jurisdictional oversight. Price volatility also increases, with speculative surges driven by OBBB incentives pushing XRP to $1 or $2, but without lasting upside because enforcement uncertainties continue to hang over custody, liquidity, and institutional adoption. Prof warns that operational friction remains in this path. Remittance taxes encourage digital alternatives, but without exemptions from securities concerns, intermediaries avoid XRP custody, keeping ODL limited mostly to smaller remittance corridors and missing out on the deeper settlement opportunities. This scenario leaves XRP useful in select markets, but delays the global transformation that richer ISO data could deliver, allowing competitors like Stellar to gain short-term advantages while global fees remain high and settlement remains fragmented. As 2026 approaches, the convergence of the One Big Beautiful Bill Act and ISO dominance marks a pivotal moment where XRP's role in global payments can either accelerate dramatically with clarity or continue slowly under uncertainty, but the momentum behind efficient settlement is now irreversible. Prof explains that with the Clarity Act, Digital Asset Market Clarity Act, finally signed into law, XRP operates in an environment of full regulatory certainty, allowing its utility to expand without friction and positioning the United States as a global leader in blockchain innovation as institutional adoption surges. If clarity never arrives, caution dominates the financial sector as banks, liquidity providers, and multinational firms hesitate to commit to digital settlement rails, reinforcing the urgent need for lawmakers to finalize rules that match the scale of the technological shift already underway. Prof stresses that XRP's resilience remains a defining strength built on speed, scalability, and neutrality, giving it the technical foundation to act as the settlement bridge between traditional finance and the new digital economy. But only firm regulatory decisions will unlock the possibility of a trillion-dollar valuation. To capture this once-in-a-generation opportunity, policymakers, institutions, and global regulators must prioritize clarity so the benefits of instant, low-cost cross-border flows reach every corridor and every user instead of remaining trapped inside outdated financial architecture. Prof makes the comparison that holding XRP today is like having a seat on the lifeboat before the broader market realizes the ship is sinking. Because when the global debt bubble finally bursts and speculative assets unwind, XRP will not follow the old market cycle. It will separate from it entirely as the world seeks real utility over hype. He concludes that the Clarity Act plays a central role in this separation, acting as the legal unlock that allows real-world settlement assets to step forward when traditional markets face stress. And based on legislative momentum, it is highly likely in his view that the act will be signed in 2025.